I mean, Brian, 50% off the April low is NVIDIA. The other Mag 7 stocks aren't quite that big, but they're big. Meta, 37.5% off the April low. Microsoft, 35. Amazon, Alphabet are 27 and 22 respectively. You know, Apple's been lackluster relative to a lot of other names in this group, but even that stock's up 15% from the April low. Are you poised to believe Roth Capital and say there's plenty of support, that the bull trend is indeed underway?
Well, I think the bull trend is underway. We're very lucky to remain bullish through all of this. But I would say that there seems to us on a very short-term basis, you're going to be surprised at this, I think there's a lot of bulls out there. And one of the guideposts that we've been looking for is kind of more company guidance going forward, and guidance is falling off a map still. So we're a little bit worried near term on that. Do I think stocks are higher at year end? Yes. Do I think they're significantly higher a year from now? Yeah. But I think even within the Mag 7, I think you have to be even more stock picking. So like we would be adding to Apple here because we think Apple's going to have a big catch-up trade. And we've maintained our overweight stance in Microsoft and Amazon. So that's what's helped our portfolios April, May, June to significantly outperform.
Shan, it's time to just lean into this market, and you know, institutional investors and hedge fund managers, and you know, I like what Adam Parker delivers when he shows up, because he meets with and he has dinners with and these idea dinners and whatnot, and there was a lot of pessimism among the professional crowd. Now, if you look at the fund manager survey and you think about where the narrative has come to, is it time to just be less fearful and cautious and just lean in with stocks 2% from a new high?
Well, I think the pessimism was likely warranted because it felt like the uncertainty that was being created was really outside of the control of any of the portfolio managers of which you speak. I think the other thing that's happening, Scott, is that we have a tax bill that's weaving its way through Congress that has some very specific and explicit and potentially transformational changes in terms of at least tax over the next 4 years or so for businesses. And so if you're looking at, and I would say it's somewhat tangential even to the AI trade, if you look at being able to expense capital expenditure on software over the course of the next 4 years, 100% in the year of your purchase, wow, that actually could create some of this monetization of the AI trade outside of the Mag 7. I think the other thing that's happened is that, you know, we have seen tariffs and we've seen that expected tariff rate continue to come down week over week over week over week. And as that continues, what we're getting is, to Brian's point, we're going to start to get some real guidance in terms of, okay, we think the tariff rate's going to be 12% or 13% or 11%, maybe 10%. But now I can start to price that in. And so I think that this earnings season is going to be very critical in terms of getting the guidance in the hands of investors, and that could allow professional investors who are more discerning around the fundamentals. I think that's why they're getting more optimistic.
Well, the big part of the story is that no one truly knows how the Trump tariffs are going to fully play out. Will deportations that we've seen hurt the economy? There's a story today, new from the Washington Post, that says Trump officials reverse guidance, exempting farms, hotels from immigration raids. ICE agents have been told to continue conducting enforcement operations at ag businesses, despite concerns about negative effects on the food industry. I wonder if we morph our concerns from what was the trade war and tariffs to just messing up a bunch of industries because you have this policy in place and you don't appear to want to waver from it at all.
Right. We're not out of the woods on tariffs at all, but we are getting more certainty. We think that, I mean, it looks like Trump wants to get stuff done quicker than expected, but it's probably going to take longer than expected. But in the face of all that, I'm just so amazed that the GDP numbers at 3.8% are 3.8%.
Yeah.
And I know it's directional, and I know we have to average first quarter and second quarter. That's 2.5% GDP growth. And by the way, I don't talk about it enough. I know you guys do, but the weak dollar, that's really good for U.S. multinational companies. So that's going to be another tailwind for earnings. And I just care about earnings.
But there are two sides to the. I feel like, first of all, I feel like you didn't answer my question. So I'm going to come back to you on that, because you didn't answer my question. So let me just go to the dollar since you went there. It is the largest underweight right now in 20 years. The dollar's lost 10% of its value since President Trump took office.
Right.
Now, you can go one of two ways on that. You could say, well, that's good for multinationals like you did. Or you could look at it and say, well, there's a direct line of evidence to a lackluster belief in the American exceptionalism trade. You guys are nodding your head like
yeah, I think there's two. I think
there's. Wait a second. Let me answer your question on the whole messing up industries. In the face of this happening, we aren't messing up industries.
Well, how do you know that?
Because earnings just grew 12% last quarter.
Well, I
in
mean,
the face of all of that.
Did you get a bunch of farm earnings reports and hotel and restaurant earnings reports? Did you see Deere? Did you see Caterpillar?
Did you see Chipotle? Did you see? I mean, there's a lot. There's a lot of companies that have done it the best that they can. Either they are giving very conservative guidance. Sometimes they're not giving guidance. A lot of my companies did, and I was shocked that they just reiterated. How about the whole financial services industry? Every single bank reiterated guidance. Not one of them lowered, and that is really quite impressive because they're at the forefront of what's going on the tariff side.
Now, the dollar thing is a legit part of the story. Falling dollar may be good for multinationals because it traditionally has been, but if you think it's falling for the wrong reason, then you sit back and you take a look at the whole big picture of where we are.
You know, in our view, it was at first falling for the wrong reason with respect to international investors losing faith in the United States. That's clearly why you had Europe massively outperform. And why industrials, by the way, are the most eclectic sector in the U.S. market, have also been one of the best performing sectors, and obviously there's a big international component of that. However, one could say that the majority of the dollar's weakness is beginning to slow down. I mean, the trend is beginning to change pretty dramatically.
I mean, 10% is a big move.
Well, if you look from where it was, but now we're starting to see solidification. Also in the Global Fund Manager Survey, we had the good fortune of being in France and in England to see our great institutional accounts in April, and a lot of those clients have massively overweight Europe, Scott.
Well, you know what they said, since you went back to the survey? That international stocks are going to be the best performing asset over the next 5 years.
Yeah, they're talking, first of all, they're talking their book, number one. Number two, that they don't have the fundamental attributes to be able to match what's gone on in terms of stock price. They don't have the economic growth. They don't have the stock or earnings growth. And so many of the people that we talk to are actually becoming, dare I say, reluctant buyers of U.S. stocks again, Scott, because they have to perform.
You can't criticize people for talking their book. You talk your book all the time. So does every single person who comes on the network. Otherwise, do you have any belief in your book?
No.
Like, what are you going to come on and contradict your book?
I talk my process and my discipline in terms of
but you talk
publishing.
about why you think your view and the stocks you have are going to work.
When you're talking,
is that talking your book?
When you're talking to an institutional client that has been, for all intents and purposes, a reluctant buyer of U.S. stocks for 20 years, and they finally were right on Europe for the first time in 15 years, Scott, of course they're taking a victory lap. So yeah, they're going to continue to be on with that because they do have an overall hatred for the United States, and yeah, I would call that talking their book and being emotional about it.
Mean reversion in the dollar. Scott, everybody came into this year saying the dollar was overvalued. Nobody said that was even before the inauguration. It was before the tariffs. It's before this tax bill and the deficit. So, to talk about the fact that all of a sudden just what's happened politically in the last 3 months is why people are rotating away from the dollar. I think that's somewhat short-sighted. But the point is that this crisis in terms of fiscal sustainability has been building for some time. Now, to Brian's point, people latched on to the German fiscal stimulus as rationale to get excited about Europe.
Yep.
And there's likely some legs to that. There's a tail to that. There's a transmission to the rest of the continent. But I think, in terms of, it's not a binary decision to move out of the dollar just because of what's happening in politics.
The ECB
there's other alternatives.